Coinbase just delivered a quarter that nobody saw coming. $3.2 billion in revenue in just 90 days, Estor's $3.2 billion. Revenue, institutional surge, the real winner of the Bitcoin all-time high. Wall Street called it impressive. The stock moved, the headlines celebrated. But here's what nobody is telling you. Buried inside that report are signals that should make every Coinbase shareholder pay attention. The biggest customers, the ones funding this growth, are quietly building alternatives. Key markets are shifting, and the stock is now priced with zero room for error. So before you buy, sell, or hold a single share, you need to see what's actually inside this report. I went through every page, every footnote, every word from the earnings call. And in the next 8 minutes, I'm going to show you the things that matter, the numbers Wall Street loved, the cracks they ignored, and my honest verdict on whether Coinbase is still a buy right now. Let's get into it. Let's start with the numbers that made every headline in Q1 2026. $3.2 billion in revenue in a single quarter. $3.2 billion. Analysts on Wall Street were modeling estimates, but Coinbase delivered with a clear beat. Plus 145% quarter over quarter expected. But here's what most people missed. The growth trajectory tells a deeper story. Q1 2025 came in at 10%. Q2 2025 came in at 15%. Q3 2025 came in at 20%. Q4 2025 came in at 41%. Base L2 total value locked hit $4.5 billion with up 200% year to date. These aren't just good numbers. At this scale, the market cap, the expectations, this level of execution is what separates Coinbase from every competitor in the space. The question isn't whether the numbers are impressive. The question is, how sustainable is this pace and what's priced in versus what's still a surprise? Now let's zoom out, because the quarterly number alone doesn't tell the full story. Looking at the last 8 quarters, revenue moved from $0 billion to $3.2 billion. That's a 357% increase. Let me walk you through the key checkpoints. Q1 2025, $1.6 billion. Crypto winter thaw. Q4 2025, $2.2 billion. ETF approvals. Q1 2026, EST, $3.2 billion. The halving frenzy. Every single quarter in this chart shows growth. And this is happening while the broader industry is growing at maybe 5 to 10%. The question isn't whether Coinbase is growing. The question is, how is this sustainable? And more importantly, who's paying for it? Because behind every dollar of growth is a customer making a bet on the future. And those bets aren't reversible without consequences. This is the most important chart in the entire report. 30% of Coinbase's revenue comes from one segment, recurring rev, consumer transaction, $1.28 billion plus 180% year over year. Institutional transaction, $800 million plus 150% year over year. Subscriptions and services, $960 million plus 35% year over year. When you look at this breakdown, you realize Coinbase is no longer a balanced, diversified company. It is a concentrated bet on recurring rev, and that concentration cuts both ways. On one hand, it means Coinbase captures almost all the value from this specific market. Every dollar spent in this space flows through Coinbase. On the other hand, it means if this market slows, even slightly, there's no other segment large enough to cushion the fall. That's not diversification, that's dependency. And dependency is fine until it isn't. The smart money always asks, what happens when the primary growth engine hits saturation? Let's look at how the revenue mix has shifted over the last 5 quarters. Total revenue grew from $1.6 billion to $3.2 billion. That's $1.6 billion of new revenue in just 4 quarters. Here's what's driving it. Institutional volume is eclipsing retail for the first time. Here's what's driving it. USDC interest income provides a massive buffer against low volatility periods. Here's what's driving it. Custody revenue scales directly with Bitcoin's price appreciation. The composition matters as much as the total. When you see one segment dominating the growth while others stay flat, you're looking at a company in transformation. Coinbase isn't just growing, it's reshaping what it is. The moat around the dominant segment is getting wider with every quarter, but the risk of overconcentration is also compounding. This is the moment where most analysts make their biggest mistake. They project the dominant trend linearly into the future. The reality is always more nuanced. Here's where the story gets even more compelling. Coinbase's gross margin in Q1 2026 was 86.0%. The trend is recovering, moving from 83.0% up to 86.0%. Gross margins are software-like. Operating expenses are flat. Every new dollar drops to the bottom line. Adjusted EBITDA, $1.5 billion, highest since 2021. Headcount, 3,400, flat despite growth. These aren't just growth company metrics, these are pricing power metrics. When a company can maintain margins at this level while scaling revenue, it means the market is accepting their pricing without pushback. That's the definition of a moat. Competitors can try to undercut on price, but they can't match the ecosystem, the technology, or the customer lock-in. The margin tells you everything about the competitive position. And right now, the margin is saying Coinbase has no real competition in its core market. Now let's talk about where this revenue comes from, because the geographic split reveals critical insights. United States, 2.4 billion, that's 75.0%. Europe, 0.5 billion, that's 15.6%. Asia, 0.2 billion, that's 6.2%. Rest of world, 0.1 billion, that's 3.1%. Here's the risk factor. The ongoing SEC litigation remains an overhang, though the market largely expects a favorable settlement or drawn-out resolution. The concentration here matters. When one geography or customer base represents a dominant share, any disruption, policy change, economic slowdown, competitive pressure hits disproportionately hard. The smart investor doesn't just look at the total revenue. They look at the concentration, the dependency, and the optionality. Right now, Coinbase's geographic profile shows both strength in its primary market and vulnerability in its secondary ones. Coinbase's forward guidance is what separates a good quarter from a great one. Guidance is 11.5 billion compared to the last actual of 7.5 billion. That implies roughly 53% sequential growth. Q2 revenue estimated $3.5 billion plus, momentum carrying over. Retail take rate monitoring, are fees compressing? USDC market cap, $32 billion plus, directly impacts interest income. Base daily users, 1.5 million plus, tracking the L2 network effect. The CEO's message was clear. We are building the primary financial account for the crypto economy, moving beyond trading to utility, payments, and global access. Guidance is the market's crystal ball. When a company guides above consensus, it signals confidence in demand, supply chain, and execution. When they guide below, it's the opposite. Coinbase's guidance here tells the market exactly where they see the next quarter heading, and the gap between guidance and analyst estimates is where the real alpha lives. Now let's talk about the risks that keep smart investors awake. Number 1, FEE compression. If traditional finance, Robinhood, Fidelity, starts a price war on crypto trading, Coinbase's high-margin retail business could collapse. The key metric here, margin squeeze. Number 2, SEC classification. If a court rules definitively that staking or core tokens are unregistered securities, a significant portion of revenue vanishes overnight. The key metric here, existential threat. Number 3, the cycle peak. Coinbase's revenue is still highly correlated to Bitcoin's price. If the macro environment forces a crypto crash, the stock follows instantly. The key metric here, macro correlation. Every investment thesis has a bear case. The difference between amateur and professional analysis is whether you can articulate the bear case as clearly as the bull case. These risks aren't hypothetical. They're active, measurable, and evolving. The question isn't whether these risks exist. It's whether they're priced in. Here are the key things you need to remember from this entire report. Number 1, institutional dominance is the story. Watch the split between retail and institutional. If institutional volume spikes, it proves Coin is no longer a retail casino stock. Number 2, Base Network is a cash cow. Look for management to highlight Base. L2 sequencer fees are pure margin and represent the most undervalued part of their business. Number 3, USDC interest income matters. With interest rates still high, the yield on USDC reserves provides a massive, stable floor to their earnings, independent of trading volatility. Number 4, expenses must stay flat. Coinbase proved they can operate lean in the bear market. If headcount or marketing spend explodes, the market will punish them. Number 5, the valuation demands perfection. Trading at a massive premium, Coinbase cannot afford a slight miss. Any weakness in forward guidance will result in a 15% plus haircut. The verdict: hold. A phenomenal business currently priced for a flawless macro environment. Wait for a post-earnings dip to accumulate. This isn't about predicting the future. It's about understanding the present well enough to position yourself for whatever happens next. The data is clear, the risks are known, and the opportunity is real, but only if you approach it with discipline and patience. So here's the bottom line. Coinbase's Q1 2026 delivered numbers that demand attention. $3.2 billion in revenue. The bull case is real and the data supports it, but the bear case is just as real. My verdict? Hold. A phenomenal business currently priced for a flawless macro environment. Wait for a post-earnings dip to accumulate. This is not the time to chase, and it's definitely not the time to panic. It's the time to be patient. Now, I want to hear from you. What's your take on Coinbase? Drop your thoughts in the comments. I read every single one. If this breakdown saved you from making an emotional decision, hit that subscribe button, because next week I'm covering another earnings report that's going to move markets. Until then, stay sharp, stay patient, and keep planting those seeds.